Without objection, the Chair is authorized to declare a recess of the committee at any time. This hearing is entitled Interest on Reserves and the Fed's Balance Sheet. I now recognize myself for 5 minutes to give an opening statement. So how did the Fed receive authorization to pay interest on reserves? At what level was it supposed to have set that interest rate? And importantly, how is this new and powerful tool for conducting monetary policy affecting our economy, which continues to disappoint after having 7 years to recover? We will hear some of these answers to these questions and many others during today's important hearing. And I feel I need to address something that came to my attention a little earlier this morning. Apparently, there's some folks on Wall Street who have sent out some alerts using that term themselves about this hearing, that somehow interest on reserves is under attack. Well, to the fine folks up on Wall Street, you're on notice. We are going to have a thorough, complete examination of what it is. I think there is a tremendous amount of questions that surround it. In fact, in February, when Chair Yellen was here testifying in front of the full committee, there was a number of concerns expressed on both sides of the aisle. In fact, as I recall, Chairman Hensarling allowed the ranking member to go along as she was asking a line of questioning about that. And so there's quite a few questions on both sides of the aisle about it. As we're looking at foreign subsidiaries and large banks being the recipients of the lion's share of this, that has a number of people very concerned of how that may also affect our small community banks and our regional banks and the liquidity in the marketplace. And so there's a tremendous number of questions that are out there, and we intend on this subcommittee to explore those. So the Financial Services Regulatory Relief Act of 2006 authorized the Federal Reserve Board to start paying interest on reserves in 2011. In response to the financial crisis, the Emergency Economic Stabilization Act accelerated this authority to October 1 of 2008. According to the New York District Bank, the Fed expected to set interest on reserves well below the Fed's target policy rate, that is, the federal funds rate. Had the Fed created such a, quote, rate floor, it would have complied with the letter of the law, Section 201 of the Financial Services Regulatory Relief Act of 2006, which explicitly states that interest on reserves can, quote, not exceed the general level of short-term interest rates, end quote. As we sit here today, however, interest on reserves is above the federal funds rate. This above-market rate not only appears to have gone outside the bounds of the authorizing statute, it also may be discouraging a more free flow of credit to an economy that can and should be flourishing. Speeding up the authority to pay interest on reserves equipped the Fed to expand its balance sheet to previously unimaginable heights and broaden its remit to, as University of California economist James Hamilton put it, quote, the decision of where credit gets allocated, close quote. Responding to the immediate financial crisis, the balance sheet more than doubled to almost $2 trillion. Subsequently, various rounds of quantitative easing saw the balance sheet more than double again. Today, the Fed's balance sheet stands at $4.5 trillion. That's about 25% of the total GDP of the United States. And as I say to folks back home, sometimes we lose perspective of how many zeros in a trillion. And I always tell them, write a 1 and 12 zeros behind it and start counting backwards to where it's 1,000, 10,000, 100,000, and you see how big those numbers really are. At the same time, the average maturity of Treasury securities held by the Fed increased from about 5 years to over 10 years, which considerably increases the balance sheet's exposure to interest rate duration risk. Almost 7 years old, the Fed's colossal and distortionary balance sheet shows no signs of shrinking. To be sure, the Fed appears to have only started thinking about an exit, as described in its late 2014 Policy Normalization Principles and Plans report, but the words principles is nowhere to be found in this description. Moreover, the plan simply mimics the same opaque, quote, data-dependent strategy for monetary policy that has left market participants scratching their heads for years, wondering what data will inform the Fed's decision-making and how will the FOMC react to that data. We will not fully realize robust economic growth until the Fed returns to a rules-based strategy for reliable supporting the free flow of goods and services with an efficient exchange mechanism, in my opinion. As former Federal Reserve Board Governor Kevin Warsh observed, quote, currency stability is one of growth's best friends, close quote. Unfortunately, monetary policy has clearly stepped outside this bound and shows little, if any, sign of returning. This lack of a clear and prudent strategy not only puts present economic opportunity at risk, it threatens the durability of monetary policy independence itself. Today's hearing provides us with another opportunity to examine how the Federal Reserve conducts monetary policy and why the development of these policies are in desperate need of a more disciplined and transparent approach. Needless to say, the Fed's high degree of discretion and its lack of transparency in how it conducts monetary policy continues to suggest that reforms are needed. With that, my time has expired. And with that, the Chair recognizes the ranking member of the subcommittee, the gentlelady from Wisconsin, for 5 minutes for an opening statement.
Well, thank you so much, Mr. Chairman, and I want to welcome the witnesses. I think everyone seems to agree that the current situation is our only rational and predictable way for the Fed to raise interest rates, which is what they've done. And that is primarily to pay interest on excess reserves. I agree with it, but I certainly can understand why perhaps Dr. Taylor here and others may disagree with why or how the Fed got here. But for those who understand the Fed's use of the IOER and to a lesser extent the reverse repo markets, this is the best way for increasing interest rates because we've got to return to some sort of normalization. We just can't have, close to zero interest rates. Congress voted to provide the Fed with the ability to pay interest on excess reserves in 2006 when it passed H.R. 3505, a bill sponsored by our chairman, Hen Sarling. Many of us voted for this bill, myself included. So we clearly and affirmatively authorized the Fed to take these actions. We know that this is not only a tool that our central bank, our Fed used, but that many other central banks are also currently employing. In other words, our Fed used the best tool for the job that is both well-established among central banks and authorized by our Congress. I do agree that it's horrible optics. It's a policy debate that is raging because, there's a concern about subsidizing the banks. I do feel encouraged to know that the profits, whatever profits are received from the Fed, actually go back to the Treasury. So it's horrible optics, but I don't think in reality we are subsidizing the banks. This is a very complicated policy, so I definitely look forward to this hearing. And I know that's true for us in liberal Milwaukee as well as conservative Michigan Heights, Michigan. I would like to yield the rest of my time to our ranking member, Ms. Waters.
Thank you very much, Congressman Moore, but I'd like to yield my time to Mr. Himes.
I will yield the time to Mr. Himes.
Thank you. From Wisconsin.
Thank you to the ranking member and to Mrs. Moore for that. Not entirely prepared for the time, but I do feel very strongly about this, and so thank you. I really appreciate the yielding the time. Look, the subjects don't get a lot more complicated than interest paid on excess reserves, but something is that there are two things that are pretty uncomplicated, and those two things are why I am here. Number one, there's a certain irony to the Congress of the United States holding the Fed up for scrutiny for their conduct of monetary policy since the crisis of 2008. With the exception of the American Recovery Act, which was profoundly controversial and partisan here, Congress has utterly and completely abnegated its role to conduct the kind of fiscal policy that classical economics and most economists would say we should have done. Yes, we passed the Recovery Act, and that was about $800 billion of fiscal stimulus. Most economists today, those who are driven by empirical analysis, would tell you that that was too little and too heavy on tax cuts and not heavy enough on infrastructure investment and the kind of things that actually put Americans back to work. Okay, so we had that fiscal stimulus. That was important. Since then, since 2009, the Congress has completely abdicated the role that economists across the political spectrum would say we should do, which is to continue with classic fiscal stimulus. So in the context of the Congress completely abnegating its fiscal role, we have had no other game in town but for the monetary policy conducted by the Federal Reserve. And you know what? We highlight the word innovative around here, and we say we want them to be innovative. Yes, their policies with the twist and with QE2 were innovative. They were different than the conduct of monetary policy, but because of the Federal Reserve's policy, including the payment of interest on reserves, we have what is, without question, the most robust recovery amongst industrialized OECD nations, however you want to play it. And I've asked this question of Chairman Bernanke time and time again. Now, this is a complicated thing, but we need to talk more about the fact that this is a transaction with two parts. Yes, we pay about $7 billion, or the Fed pays about $7 billion. Meanwhile, the Fed is returning about $100 billion to the United States Treasury. Those are the two halves of this transaction, and I do hope we have an opportunity to discuss that in this hearing. And I thank the ranking member for the time. And yield back.
Gentlelady's time has expired. And I imagine we will get into a few of those issues today. With the testimony of our panel of experts, we welcome today testimony of Dr. Robert Eisenbeis, Vice Chairman of Cumberland Advisors. Also next, Dr. Todd Keister, Professor of Economics at Rutgers University. Next, we have Dr. George Selgin, Senior Fellow at the Cato Institute. And Dr. John B. Taylor, the Mary and Robert Raymond Professor of Economics at Stanford University, will round out our panel. And so each of you will be recognized for 5 minutes to give a presentation of your testimony, which we have received written copies of previously. And without objection, each of your written statements will be made part of the record as well. Before I forget, we were supposed to have Dr. David Malpass, who was supposed to be part of this panel today. Unfortunately, he had a death in the family, and we wish him and his family all the best. They are in our thoughts and prayers collectively. I would like to submit for the record without objection his written testimony as well, and would ask that we make that a part of the record without objection. So without objection, so moved. So with that, Dr. Eisenbeis, you will have 5 minutes, and I know that was an issue that was brought up that you touched on in your written testimony, so looking forward to this. And please,
thank you very much. Chairman Huizenga, ranking members Moore and Waters, I really appreciate the opportunity, and I'm honored to be here today. I want to address, in particular, certain misconceptions about the Federal Reserve's balance sheet and some of the fund flows that take place between the Fed and the Treasury and how that interplays with interest on reserves. Often the Fed is compared to a private sector bank, but there are really some fundamental differences between the Fed and a private sector bank. The Fed is a government entity, and when analyzing payment flows and fund flows and balance sheets, I think it's really best to look at the process and implications from the perspective of the consolidated government's balance sheet rather than separately the Federal Reserve and the Treasury. Unlike a private bank, to purchase assets, the Fed really doesn't have to go into the marketplace and pay interest on funds in order to generate the resources to purchase government securities. When it purchases a security, essentially what it does is it increases the reserve account of the seller's bank's reserve account, and had it paid for treasuries by drawing down its stock of Federal Reserve notes, we would have said the Fed had printed money and monetized Treasury debt. It's also important to understand that unlike deposits at a private sector bank, reserves never leave the Federal Reserve when one bank or one of its customers engages in a transaction. Ownership of a reserve account may change, but the funds never leave the Fed.
Dr. Eisenbeis, I want to interrupt 1 second because this is a very important testimony. We want to have you move that mic a little closer to you, and we're trying to see if we can turn the volume up as well. So,
certainly, I'm sorry.
All right. No, that's not your fault, so appreciate it. Thank you.
Okay. Now, what about payment of interest on reserves? The Fed is paid interest by the Treasury on its portfolio holdings. It then extracts its operating costs, including interest payments on reserves, and returns the remainder to the Treasury. From the perspective of the consolidated Fed Treasury government balance sheet, The Fed purchases higher-cost Treasury debt off the market and replaces it with another form of de facto government short-term debt, paying 50 basis points. If this intragovernmental transfer of funds between the Fed and the Treasury were settled the way interest rate swaps are settled, by netting, there would always be a net payment or transfer of funds from the Treasury to the Fed. Furthermore, Treasury securities are effectively retired because of the fact that the government owns its own debt. The Treasury is covering the Fed's operating costs and effectively is making those interest payments on reserves. So it's a mistake to characterize Fed remittances, as is commonly done, as a return of profits made by the Fed to the Treasury. It's only due to a flaw in government accounting that the Treasury can count such remittances from the Fed as revenue for budget purposes. This is clearly a case of questionable accounting and misleading when it comes to the treatment of government revenues and resources. Are interest payments a subsidy to banks? This is a common question and concern. In the wake of the Great Recession, interest on reserves became an essential tool for the Fed to influence short-term interest rates. For most of history, the Federal Reserve had paid no interest on reserves at all. But requiring banks to hold a portion of their assets as non-interest-bearing reserves against their deposits effectively reduced bank earnings and functioned like a tax. Because this tax was high, and especially during inflation periods like we had in the 1970s and 1980s, many banks opted to give up their membership in the Federal Reserve, and the Fed even resorted to providing free payment services, the equivalent of toasters we saw in the private sector, to offset the ongoing cost of membership. Predictably, banks sought to minimize excess reserves by expanding loans, thus converting excess reserves into required reserves. For the banking system as a whole, this practice created a money multiplier where $1 of reserves could conceptually support even a tenfold increase in the money supply and potentially trigger an explosion in inflation. This unwelcome prospect explains why economists and some members of the FOMC are and have been concerned about the need to wind down its portfolio and decrease the amount of excess reserves and return interest rates to normal. In this context, the Fed ability to pay interest on reserves is critical to keeping interest rates, the money supply, and inflation under control, consistent with the Fed's dual mandate. However, there's an additional issue when we recognize, as shown in Figure 1 attached to my written testimony, that a substantial portion of the excess reserves in the financial system are actually in the U.S. subsidiaries and affiliates of foreign banks, which now account for 40% of the excess reserves, but only about 10% of U.S. domestic deposits. Because of this imbalance, they also receive a disproportionate share of the interest payments on reserves relative to domestic institutions. There are really two explanations for this imbalance. First, the Dodd-Frank Act changed how deposit insurance assessments were charged. Large banks, mainly those over $500 billion, now pay 15 basis points or more on total assets. This means that while they currently earn 50 basis points on their reserves, their net return is 35 basis points. It was 10 basis points prior to the rate change in December of 2015. In contrast, foreign banks aren't subject to the 15 basis point assessment. They're able to earn the full 50 basis points on their excess reserves. But foreign institutions headquartered in Europe or Japan, for example, where policy rates are now negative, the spread is even wider. In the case of a European bank, it's now 90 basis points, and reserves at the Fed are clearly an attractive asset, an earning asset.
Dr. Eisenbeis, I have to interrupt. Time has expired at this point, and we'll have to return back to you during questions. So,
Fine.
All right, appreciate that.
Thank you.
Dr. Keister, you are recognized for a generous 5 minutes as well, so we thank you for that.
Thank you, Mr. Chairman, Ranking Member Moore, and members of the committee. The ability to pay interest on reserves is an important policy tool, and Congress
Dr. Keister, I'm going to ask you to pull that mic as close as you can as well.
The ability to pay interest on reserves is an important policy tool, and Congress's authorization of these payments in 2006 was a welcome development. In the aftermath of the financial crisis, the Fed has come to rely more heavily on this tool than was previously anticipated. Because paying interest on reserves is still relatively new in the U.S., there's naturally some uncertainty in the minds of both the public and policymakers about the implications of this tool. In my comments today, I will argue that continuing to pay interest on both required and excess reserves is not only essential for the implementation of monetary policy, but also sound economic policy. I will focus on 4 key points. First, paying interest on excess reserves has no cost to the taxpayer. To understand why, it's helpful to walk through the mechanics of how bank reserves are created using a simple example. Imagine we start with a situation in which I personally own a U.S. Treasury bond, and the U.S. government regularly pays interest on that bond to me. Now suppose I decide to sell this bond and that the Fed purchases my bond. When this transaction takes place, the Fed credits my bank with reserves equal to the value of the bond, and my bank credits my account in the same amount. In this new situation, the Treasury pays interest on the bond to the Fed pays interest on the reserves to my bank, and my bank pays interest on my deposit to me. In other words, the Fed paying interest on reserves is a link in a chain of payments that replaces payments the Treasury would otherwise be making directly to bondholders. Seen this way, the operation clearly creates no cost for the taxpayer. In fact, as we've already heard, since the interest rate on excess reserves is generally lower than the interest rate on long-term Treasury bonds, the operation creates a net gain for the taxpayer. My second point is that paying interest on excess reserves is not a subsidy to banks. Suppose I keep the money I receive from the sale of the bond in my savings account. Then my bank would be earning 50 basis points on the newly created reserves, but it would be paying me approximately 30 basis points on my new deposit. My deposit also increases the bank's costs indirectly by raising the deposit insurance fees it must pay to the FDIC and by increasing its leverage. Overall, the bank may make a small profit on this transaction, but to a first approximation, it will roughly break even. So taking into account the costs as well as the benefits of my deposit to the bank shows that earning interest on excess reserves does not represent a subsidy. My third point is that policy should be designed to encourage banks to hold excess reserves. Bank reserves are the lifeblood of our nation's payment system. Every business day, more than $3 trillion of payments are made over the Fed's network. Banks are making these payments on behalf of their customers using the reserves they hold on deposit at the Fed. Prior to 2008, when no interest was paid on reserves, the Fed needed to create a scarcity of reserves to keep market interest rates positive. In fact, reserves were so scarce that our payment system could not adequately function using those reserves alone. Instead, the Fed permitted banks to run overdrafts in their reserve accounts for a few hours each day, solely for the purpose of allowing the payment system to function. These overdrafts were large at times, with an average daily peak value of more than $180 billion in 2007. One byproduct of the large expansion of bank reserves that has occurred over the last few years is that these intraday overdrafts have fallen by more than 90%, decreasing the risk to the Fed and ultimately to the taxpayer. In addition, payments are on average being sent earlier in the day, eliminating bottlenecks, reducing delays, and enhancing the resilience of our payment system. This brings me to my final point. The Fed's balance sheet should remain larger than its pre-crisis level, even in the long run. While the Fed's balance sheet should and will shrink substantially from its current level, it would be a mistake to return to the pre-crisis approach of creating a scarcity of bank reserves to control interest rates. There have been substantial changes in the financial system since 2008, including a greater awareness of liquidity risks and new regulations that are increasing banks' demand for safe, liquid assets such as reserves. Going back to the old approach of controlling interest rates by creating a scarcity of reserves not only runs counter to the goals of these new regulations, but also would likely be less effective in achieving the desired level of market interest rates than in the past. In contrast, the Fed holding a moderately larger balance sheet and relying primarily on the interest rate on excess reserves to steer market rates would be a more effective way to implement monetary policy going forward, while simultaneously promoting safety and efficiency in the payment network that underlies our financial system. Thank you again for this opportunity to testify before you today. I would be happy to answer any questions.
Thank you, Dr. Keister. Appreciate that. And with that, Dr. Selgin, you are recognized for 5 minutes.
Mr. Chairman, Ranking Member Moore, distinguished committee members, The original intent of the 2006 legislation granting the Fed permission to pay interest on reserves was to resolve what in retrospect was a rather minor inefficiency in the payment system related to the opportunity cost of holding non-interest earning reserves. The accelerated deployment of that authority in 2008 was undertaken as a contractionary monetary measure. This was its avowed purpose. At the time, the Federal Reserve believed that its emergency lending would create excessive credit in the system and prevent it from reaching its monetary policy targets. We know in retrospect that this decision was tragically mistaken, because at the very time that the Fed began to encourage banks to hoard reserves rather than lend them, the economy's total spending was collapsing, and it continued to collapse afterwards from what had been a growth rate of about 3% at the beginning of 2007 to a rate of minus 3% at the end of 2008, beginning of 2009. The combination of interest on reserves, which was designed to prevent banks from lending either to each other or to the market in general, and massive reserve creation by the Federal Reserve, resulted in a massive accumulation not just of reserves, but of excess reserves, that is, reserves held without any corresponding increase in required reserves that would occur if deposits had also expanded. In fact, bank deposits did not increase despite a tremendous increase in total reserves in the system, as they normally would. Banks before 2008 seldom held more than $1.8 billion in excess reserves. At some point after this policy was implemented, after the Federal Reserve also had engaged in its third round of quantitative easing, they held $2.7 trillion of excess reserves, and they still hold about $2.3 trillion. Normally, banks shed their excess reserves by trading them for higher yielding assets or lending them to other banks. Even if they don't want to incur risk, they can trade their excess reserves for higher yielding, safe Treasury securities. Interest on reserves eliminated the incentive for them to do that and to therefore contribute to a more general expansion of deposits and credit by making reserves earn more than Treasuries, as they have done for the most part ever since the policy was implemented. The result, to use some economics jargon, is that the normal money multiplier, which gives you the relationship between total bank reserves in the system and total money supply, including bank deposits, collapsed. This caused quantitative easing to be much less effective in increasing spending, income, and employment than it would have been otherwise, because almost all the new reserves created by the massive quantitative easing programs the Fed undertook simply piled up in banks, and mainly, as Dr. Eisenbeis has explained, in foreign banks. The large expansion of the Fed's balance sheet that has gone along with this hoarding of bank reserves, and what I mean is that has been made the accumulation of excess reserves possible, has also involved, because banks have not increased credit proportionately, a tremendous increase in the Federal Reserve's share of financial intermediation from about 10% of total allocation of credit in the economy, of money-based credit, to just about 30%. Ladies and gentlemen, central banks have never been intended to be efficient allocators of the nation's scarce savings, and the Fed is no exception. It was an inefficient investor of savings before the crisis. Naturally, it was never intended to be looking for productive lending opportunities. The changes in its balance sheet since have made it a far more inefficient employer of savings. The inefficiency that results from the feds having nationalized so many savings far exceed those that the original act allowing payment of interest on reserves was supposed to correct. Ladies and gentlemen, I have very little time, but I will simply say that, contrary to what some of the other speakers have said, we desperately need to return to the old-fashioned way of conducting monetary policy by having the Fed unwind its balance sheet, get rid of the assets it has accumulated, allow banks to earn interest only on required reserves, and encourage them not to hold excess reserves, but instead to engage in productive lending. I'm going to yield the rest of my time to Professor Taylor, who's a lot smarter than I am. Thank you.
With that, your time has expired, Dr. Selgin, but we are very pleased to welcome back Dr. John Taylor back to the committee, and we look forward to your testimony. With that, you are recognized for 5 minutes.
Thanks, Mr. Chairman, Ranking Member Moore, and other members of the committee for inviting me to talk about this important but complicated subject, interest on reserves and the Fed's balance sheet. Since reserves are such a large part
sorry, Dr. Taylor, I'm going to ask you to...
Since reserves are such a large part of the Fed's balance sheet, I thought maybe we should look at the balance sheet to begin. So I put a picture on it on the front page of my written testimony. I've simplified it a bit, but basically it's the main issues. If you look at that, you can see that the size has increased. Measured by assets, it's gone from $842 billion to $4,478 billion. Part of that is because currency has increased. Currency's gone from $758 billion to $1,407 billion. That is not unusual. That's the growth of the currency. What is unusual is this gigantic increase in securities, purchases of Treasury securities and mortgage-backed securities by the Fed, which have gone from $760 billion to $4,234 billion. All those figures are in the table. Finally, what this has led to is a literally explosion of reserves. Reserve balances is what the Fed calls it, from $14 billion to $2,401 billion. I have a chart on page 2 of my testimony which shows how this occurred. It's quite dramatic. This occurred, of course, to finance the purchases of these securities. In the correspondence with QE1, QE2, and QE3, each successively jumping the amount of reserves, is what shows you that close correlation between the need to finance QEs and the financing through reserve creation. When you increase the supply of reserves so much, basic economics tells you that's going to drive the market interest rate down close to zero. And in fact, it did in the fall of 2008 very rapidly, even faster than the Fed was able to adjust its target. There's another chart showing that in my testimony. But this fact that such a gigantic increase in supply of reserves will drive the interest rate down brings us to the topic of this hearing, because to prevent that, the Fed has instituted interest on reserves and taken the legal, the law to do that. I think this disconnect between the interest rate set by the Fed through interest on reserves, which you could see had happened in December. They want to raise the interest rate by 25 basis points, so they raised interest on reserves by 25 basis points. No necessarily change in the amount of reserves to do that. So there's a disconnect between the interest rate the Fed is setting and the amount of reserves, the amount of money in the economy. I think that disconnect is necessary now because of this gigantic amount of reserves. There's no choice, otherwise the rate will fall to zero. But as a long-term proposition, I do not think it's a good idea to make that disconnect. It does give the Fed another tool, but quite frankly, it enables the Fed to what I call a multi-purpose discretionary institution instead of a rather limited purpose rules-based institution. That extra tool gives it the ability to do that. In this sense, I think it's promising that the Fed, in their policy normalization principles and plans, said that in the longer run, they will hold no more securities than necessary to implement monetary policy efficiently and effectively, and that will hold primarily Treasury securities. I would like the Fed to describe to us what effectively, primarily, and efficiently means, because it's not clear. I think it would be very useful if the Fed said they were going to bring that balance sheet down to a level where the supply and demand reserves determined the interest rate, as in any other market, a market-determined interest rate. To do that, to clarify that they're not going to have to pay interest on excess reserves in that mode, and remember, that gigantic increase in reserves will come down substantially. We don't know how much it will come down, but come down to the point where the interest rate is determined by the supply and demand for reserves or money as it has in the past. And again, it's true that this gives you additional tool, but I think that additional tool is one of the problems that we have. It would be important for the Fed to say, we're going to set monetary policy not with its extra instrument, which enables it to do so many other things, credit allocation, things that are properly fiscal policy. It's not the job of the Fed to do fiscal policy and credit allocation, but this extra tool enables them to do that. So I say go back to the basic way it worked before. The world is different. It's not exactly the same. I think we'll have a better Fed, a better monetary policy in that situation. Thank you, Mr. Chairman.
Thank you, Dr. Taylor. Appreciate that. And you can see we've got a lot of issues to dive into, a very short period of time. And with that, I'm going to recognize myself for 5 minutes for questions. I will point out to my colleague that we had a similar panel of PhD economists who was talking about the stimulus, and I asked the question, who here on the panel believes it should have been about half the size? A few hands went up. I asked who here believes it ought to have doubled. One hand went up, and the simple fact is that economists are split as to whether we had spent half as much or twice as much. We'd probably end up about right where we are. The question is, do you want more debt or less debt as we're moving forward? Dr. Eisenbeis, I know you got cut off a little bit, but Treasury is making the payments as a profit was a point made. I'm curious if you'd like to still continue to unpack that, and I know Dr. Keister had an opposite view of that. And I'm going to quickly try to move along to Dr. Taylor, and then the main question that I have is how in the world are we going to unwind all this? And Dr. Taylor was starting to get at that. So Dr. Eisenbeis.
Well, I think that the proper way to view the interest payments and what Dr. Keister was essentially addressing was from the perspective of the financial institution, how it deployed those funds once received and how it affected the customers. I was talking more about how one should view the transfer of funds from the Treasury to the Federal Reserve, and essentially my main point was that it's the Treasury who's paying the interest on reserves. When it comes to unwinding the balance sheet, the Fed faces a really difficult problem, because if you just let the Treasury securities run off, it would take until about, through the normal maturing process, till about 2029 before you would return the balance sheet to something close to what I would call equilibrium, where essentially mainly you have, as Professor Taylor was talking about, sufficient excess reserves to conduct monetary policy, and then backing of the currency, which would imply a currency level somewhere around 1.3 trillion or thereabouts.
Okay. Thank you. Sorry, I have to quickly move along. I would like the chart up that was a Bloomberg. This was a Bloomberg chart that used Dr. Taylor's information, but I would be remiss if I didn't take an opportunity, having Dr. Taylor here, talk about a rule-based Fed policy and sort of where the federal funds rate was and where that dotted line is, what the ideal rate is calculated by the Taylor rule. It pretty much shows, it looks like the Fed was somewhere 2 to maybe 3 or 4 quarters behind you, Dr. Taylor, on where they should have gone. Are you care to address this and take a stab at
yes,
where
thank you,
we're at?
Mr. Chairman. I think that this shows is in the period before the crisis, the interest rate set by the Fed was much lower than it would have set had it been operating policy as in the 80s and 90s. It then caused search for yields, excesses in the housing market, and eventually the bust. So it's a real concern. If it was closer to the rule, whatever rule, would have been better. During the panic period, they brought interest rates down very rapidly, seemed appropriate, But since then, the rate has been not what I would say rule-based, as in the past, hanging around zero, and I think that's been a problem.
And I know that I had suggested that the chair could create the Yellen rule at some point or another if there was any kind of rule that needed to be had, and that's part of our FORM Act, a Federal Oversight Reform and Modernization Act that has passed the House. I'd like you to quickly, Dr. Taylor, I know you were starting to talk about that on page 4 and 5 of your written testimony. What happens when the IOER, the excessive reserves, interest on excessive, not the required, but the excessive reserves, declines? Who benefits from that? You were starting to talk about that, and Dr. Eisenbeis was a little bit, but care to address that, please?
Well, at this point, I think the testimony by Mr. Eisenbeis makes this clear. It's necessary to do this because reserves are so high, so if they want to raise the rates, they have to. But it's as if the Fed has been borrowing instead of the Treasury, so in that sense, it's a wash. My concern is that this extra instrument really creates many other ways for the Fed to intervene in the economy, and I think people don't benefit from that. Maybe one sector will benefit, but that's not the job. The Fed is not supposed to help certain sectors. It's supposed to help the whole economy. That's why it's been successful when it's done that.
Just so we're clear, Dr. Selgin, we got 5 seconds.
No, I actually had another point.
Okay, all right. Well, my time has expired. So, with that, the chair recognizes the ranking member, Ms. Moore, for 5 minutes.
Thank you so much, gentlemen, again for appearing. I have to say that the chart that you just put up, Mr. Chairman, was very confusing. I mean, to the extent that it was more theoretical than anything. I guess I am confused, and I guess I'll let Dr. Taylor and Dr. Keister sort of explain this to us further. I think that the Fed has been operating under their mandate. That the Taylor rule has been an intellectual discussion, and it's not something that the Fed has relied on. They've relied on, and right now, the current Fed is operating under that same mandate. And they were operating under that mandate in the period that you've used to calculate your Taylor rule. So let me start with Dr. Keister to sort of respond to the chart we saw.
Sure. I think it's important to remember, as we focus, for example, on that period in the early 2000s when the Fed's interest rate was lower than the Taylor rule would have suggested, that there were very real risks at that time. After the crash of the stock market and the collapse of the dot-com stocks, there was a very real risk of falling into a deeper recession, and we're worried about deflation. The fact that those risks did not materialize doesn't mean the Fed got it wrong. It could be interpreted as meaning the Fed got it exactly right. By easing policy more than would have been suggested by a rule that was based on an earlier time period, the Fed mitigated those risks and helped the economy recover.
Okay. Dr. Taylor, so Dr. Keister said that, it essentially said that the Taylor rule really didn't take into account the recession, didn't really take into account other risks to the system, and I guess I give you an opportunity for a few seconds to respond to that.
There are many reasons the Fed and people who work at the Fed give to explain why the interest rate was so low at that point in time. You just heard one of them. There are others, that there were international effects, that we couldn't do much about interest rates. I think the bottom line is, it's not theoretical. It's based on what worked in the 80s and 90s until this time. We had basically a good, stable economy. Few recessions. The ones that occurred were mild. Unemployment much better than what happened in this Great Recession. So that experience has led people, economists, to think that that kind of a policy, it's not rocket science, is better than one that just ignores it. And when the Fed ignores it, it causes problems, and that chart shows it big time.
Dr. Keister?
Sure. My main concern about the FORM Act is that any rule, the that performed well in a certain time period may not perform as well in the future. I think we want the Fed to be forward-looking, not backward-looking in its policies, and we want the Fed to react as there are changes in the environment. Recovering from the financial crisis, as the Fed's balance sheet and markets continue to normalize, I think we should expect the environment to be different than it was, particularly in the 1980s and the 1990s. And we'd like the Fed to have to maintain the flexibility to react in the most appropriate way as the environment continues to evolve.
I want to change the subject just a little bit with my remaining time to you, Dr. Keister. If the Fed's goal ultimately is to help our economy grow, I mean, we're suffering from low growth. The presence of these reserves, theoretically, even if there's a disincentive to lend it from bank to bank, there still is an incentive to provide these resources to economic development and to businesses with what the Fed is doing. Am I correct in that?
Yes, that's exactly right. And that's a point that I hope my little simple example helps clarify. So when the Fed purchases the bond from me, it's holding reserves, but it also has a new deposit for me. That doesn't in any way prevent my bank from being able to make loans and create credit for businesses and consumers. By holding more reserves, the bank is safer and it's sounder, but it still has every bit as much incentive to lend out to customers.
Okay, thank you. I yield back.
Gentlelady's time has expired. With
4 seconds.
4 seconds, yes, I can grant you the 4 seconds back if you would like.
No, I'm just saying that I yielded back.
Okay. Point taken. With that, the chair recognizes the vice chair of the committee, Mr. Mulvaney of South Carolina, for 5 minutes.
Thanks very much, Mr. Chairman. I don't know where to begin. A couple different topics. Dr. Taylor, you said something towards the tail end of your testimony that the tool, the interest rate on reserves, allowed the Fed, in effect, to set fiscal policy. Did I hear you correctly, sir? Could you expand on that a little bit? If that was that, is that?
Yes, that's what I said. So given that the interest rate can be determined by this interest on reserves, means the balance sheet can go wherever it wants to go. That's the disconnect that I mentioned. So in that circumstance, the Fed could buy mortgages. It could even buy student loans. It could buy automobile loans. In fact, of course, it did buy mortgage-backed securities early on.
But they could do that. They could
So
do
that's a
that
credit
anyway, right?
allocation issue. It seems to me that's the kind of thing that Congress should be deciding which agency should be doing.
I don't think I'm disagreeing with you, but they have that. I asked Ms. Yellen about that, and her predecessor as well. They have that ability anyway, don't they? They could buy municipal debt if they want to. That's one of the authorities they have.
I think the difference is if the balance sheet and the supply of reserves has to be at a level, the supply is at a level where it's equilibrating the interest rate. It doesn't have the ability to move it anywhere at once. The connection between interest and money is a classic one.
Yep.
They've severed that. And so that means there's much more ability to expand the balance sheet. They could not have expanded the balance sheet to where it is now in my picture and still be able to have a positive interest rate without this tool.
Dr. Selgin, do you have a thought on that?
Yes, sir. The difference
Please pull your microphone close.
Sorry. The difference that interest on reserve makes is that by encouraging banks to hold large quantities of excess reserves, it effectively gives the Federal Reserve a larger share of savings to play with and to intermediate, and that in turn means that whatever assets the Fed chooses to buy and hold, that its influence on the overall allocation of credit is much greater under an interest on reserve regime than it would normally be.
Have you gentlemen given any thought to why this? My understanding is that when this tool was used in December of 15, it was the first time that's been done. Dr. Yellen was here before that, and the Fed had anticipated, hinted that they were going to use this tool. I remember asking her, hearing why she expected to use that tool as opposed to moving the Fed funds rate or some other traditional tools, shrinking the balance sheet, for example. And she said, well, she gave the answers we always get, which is we have many tools available to us, and we just happen to pick this one this time. Do you gentlemen give any thought to why you think this tool was used in December of 15th and not one of the more, December of 2015 and not one of the more traditional tools? Dr. Selgin.
The fact is that the Federal Reserve was unable to use its traditional tools. Let me go back to when they first implemented interest on reserves just for a moment. The original idea was that interest on reserves would put a floor on the actual effective federal funds rate, and that would help the Fed to keep its target, which was still above zero at that time. It didn't work out that way. The effective rate at which actual tradings were occurring continued to be below and to fall further below the Fed's target. Subsequently, they changed how they described their target by saying, well, the target is now a band, where the interest on reserves is the upper part of the band, and the lower part is either zero or subsequently the overnight repo rate. Frankly, it's like an archer who misses a target, then moves the target, and then says, see, now we're meeting the target again.
Follow that, but but why? Why would they use that tool and not another one? Why were the other tools ineffective?
Well, the alternative would have been to raise interest rates by selling assets, and because the Fed had acquired such a large proportion of mortgage-backed securities, which it did not dare sell and could not sell for much, and because of long-term treasuries it held, it feared the balance sheet repercussions to itself, the capital losses, and also the consequences for the values of these securities in the market.
Does the Fed have to mark the assets on its balance sheet to market occasionally or not?
No, it does not. And it's an interesting question because the Fed, unlike normal banks, can actually become insolvent and have negative capital without closing shop. The problem is in the income statement where, of course, it would have to go hat in hand to Congress if it were not able to earn enough income to cover its operating expenses.
I hope we get a second round. I thank the chairman. Thank you, gentlemen.
Thank you. Gentleman's time has expired. With that, Chair recognizes Mr. Foster of Illinois for 5 minutes.
Thank you. Let's say I'd like to start with Dr. Eisenbeis. You mentioned that if the Fed just left all of the assets run down, that it'd be around 2029, I think you said. And is that sort of similar to what's happening in the last couple of years, where I believe they're trending down?
No, they haven't been trying to reduce the balance sheet at all. They have been reinvesting the maturing portfolios. So they have not yet made the decision to stop reinvesting and let the balance sheet run off. So my number assumed that they would do that now. The longer they postpone, then that 2029 figure gets pushed out further.
Okay, and is there an understanding, an agreement on what would happen if they let it run down on the trajectory you talked about, unload things faster or slower? What effects that would have on short-term, that effect by itself on short-term and long-term interest rates?
Well, in the short run, what it would do is if the Treasury, in particular, maintained the volume of outstanding securities, this would put more collateral into the marketplace and relieve some of the pressure on collateral and have an implication for interest rates. So right now, the argument is that the size of the balance sheet, because of the interest rate impacts we've been talking about, is actually a tightening. This would actually free up and be a little bit more of a moderating force on interest rates as a whole.
Is there a limit on how rapidly you think they should unwind the balance sheet?
Well, the problem is that they risk, if they have to unwind it faster, and if that's necessitated because of restrictions on interest payment on reserves or inability to sort of sterilize the excess reserves, if the money supply started to grow too rapidly, then they would have to sell assets. And if interest rates are rising during this environment, which presumably would be the case, they would have to sell those assets at a capital loss. And rather than recognizing the capital loss on their balance sheet, they would be able to create what's called a deferred asset account or a negative asset account, and try to get your head around what a negative asset account is.
Well, I'll ask the Enron guys.
Sure. But if you match that negative asset account against their capital account, they could quickly go insolvent, as Dr. Selgin has indicated. And how would the world respond to seeing a negative
Okay, well, so it sounds like, sort of the default scenario here would be just to let everything run down by about 2029, and then used other tools to regulate interest rates as it sort of gradually. Is there anyone who believes that that scenario would not work and could not be made to work?
So my problem with that is 2029's a ways away, and that whole period is almost becomes permanent, that particular method of controlling the interest rate. I think it'd be far better to bring the balance sheet down, bring reserves down more rapidly. If it's done strategically, clearly, I don't think it should be a problem. There's huge controversy about how much QE actually did anything to interest rates. I think it sometimes surprised the market and moved rates, but if it was clear, I think they could reduce that balance sheet much more rapidly than 2029.
Okay, and Dr. Selgin, you indicated at one point that the Federal Reserve couldn't sell the MBSs that it owned. Weren't these government-backed MBSs? Was there ever a point when they could not sell them?
The problem isn't that they can't sell them. The problem is they can't sell them for anything like what they're valued at on their books. So it's the problem that we've been talking about the Fed bearing losses on those securities by selling them.
And so did this have anything to do with the fact they were mortgage-backed securities, or just the fact that
they were mortgage-backed securities
but it had
purchased?
nothing to do with the mortgage market directly?
No, there were
hard to sell?
mortgage-backed securities purchased during the crisis when they're precisely because their values at the time were doubtful, and they're purchased as part of an emergency effort to help the financial institutions that had been holding those assets.
Okay. Yeah, I may have some follow-up questions. I don't completely understand that risk, because I thought at the time that these were government-backed MBSs, and in fact it was not noticeably different than buying other government-backed assets. Anyway, okay, let's see. Just a final observation on the very first plot, what showed the deviation from the Taylor rule. I think if you look at the point of maximum deviation and then think about when elections were being held, I think you come up with an interesting argument for an independent Federal Reserve. And with that, I will yield back.
Gentleman yields back. Point well taken. With that, we will be going to Mr. Pittenger of North Carolina for 5 minutes.
Thank you, Mr. Chairman. Thank each of you for being with us today. Mr. Eisenbeis, if the Fed's balance sheet strategy was working, then why haven't normal market conditions returned even after 8 years of financial panic?
Could you repeat the question,
If
sir?
the Fed's balance sheet strategy was working, then why haven't normal market conditions returned even after 8 years?
Well, that really depends upon how they employ the tools that they use and what the growth rate in the economy is, and how if we're on the present path, there is a chance that they could get into a normalization situation. But I think the risk is that if the economy starts to pick up growth, because it's one thing if they're growing at 2%, but if the economy starts to grow, that means that inflation is going to start potentially to pick up, and then they're in a bind as to what to do.
Well, as such, then what is stopping the Fed at this point from naturally winding down the balance sheet?
Well, I think they're really in a risk-averse situation and risk management at this point in time. They are just really cautious about the fact that they have not been achieving their inflation objective. The labor market clearly is improving and doing quite well by comparison, but they're essentially wanting to keep their foot on the throttle from their perspective to get inflation up to their 2% target.
Thank you. Dr. Selgin, in terms of economic opportunity, how much damage is being done from leaving the balance sheet too big for too long?
I wish I could give you an answer to that question. What we can say is that the holding of, or the allocation of so much savings to the sectors that the Fed's balance sheet is supporting certainly does not contribute to productive investment as it might if the same savings were allocated by the commercial banks and other private lenders. We know that none of it is supporting lending, commercial lending of any kind. It's certainly not supporting lending to small businesses that is regarded as very important to a recovery. I believe it's an important factor, by no means the only important factor in the sluggish economy, and I believe it's one of the reasons why we have, despite the Fed's seemingly aggressive monetary expansion, we haven't really seen a very robust recovery coming out of that. The best that people can say is that it's not as bad as Europe. This doesn't seem to me to be a very clear and an endorsement of what the Fed has been up to.
Thank you. In like manner, in terms of monetary policy independence, what damage is leaving the balance sheet too big for too long?
Sorry, could you repeat that?
In terms of monetary policy independence, what damage is it to leave the balance sheet too big for too long?
That depends on how Congress responds to having such a big balance sheet and having the Fed maintain it, of course. I think that there's no reason why the Fed can't continue to be independent, but I think that Congress should limit its dependence to the extent of trying to tell it that it should not stay in this situation forever. If it's undermining Fed independence, to merely tell them to go back to business as usual and to do it as quickly as possible, well, then I say the Fed has got rather too much independence to begin with.
Thank you. Dr. Taylor, to what extent did the remarkable expansion of the Fed's balance sheet mitigate the financial crisis?
I think in the fall of 2008, when they provided lender of last resort loans in this panic period, it seems that was overall good monetary policy. And that's when the balance sheet first began to expand. However, those liquidity facilities drew off very quickly. And I think after that, certainly after early 2009, I raised big questions whether that did any good at all. There's lots of studies. I did an early study back in 2009, said it was not effective. Some argue it's actually counterproductive.
To what extent then did it exacerbate the problem?
I think it's exacerbated the problem because it's really delayed the time where the Fed could get back to the kind of policy that worked so well in the past. It's been a reason for them not to go back. And just this very discussion is they find it so difficult to reduce the balance sheet. It shows you one of the concerns many of us had about increasing the balance sheet in the first place. It's almost like we told you so type of thing, although I'm not doing that right here.
Thank you. My time has expired unless the chairman wants you to comment.
Gentleman's time has expired. With that, the chair recognizes Mr. Himes of Connecticut for 5 minutes.
Thank you, Mr. Chairman. And, I'm not sure I've got a lot in the way of questions, but I'm here and concerned about this because big picture what we're talking about is something that maybe some of my colleagues don't appreciate, which is the profound importance of the independence of monetary policy and of a flexible central bank. Most Americans can understand why a strong military is important to national security, why high taxes can affect economic vibrancy. Most of them don't necessarily get the historical fact that an independent and flexible and smart central bank is the very cornerstone of a functioning capitalist economy. And I can't help but feel that this hearing and the ongoing Fed bashing by my Republican friends and the scaling back of authorities and the audit the Fed are all part of an effort that if they are joined, the legacy of those who join in on that effort will be to erode one of the very cornerstones of this country's vibrant economy, which is an independent monetary policy. If we had had a Fed-caused disaster, I would understand why we would be having this conversation. But the reality is that in the last 8 years or so, the Fed was the one adult in the room. And I made this point in my opening statement. Congress failed in its responsibility to provide enough fiscal stimulus to do what it should have done. In the absence of good fiscal policy, and I'm going to come back to this because the chairman took exception to what I characterized as an economic consensus, The Fed was the only game in town, and it's a fair thing to question what their authorities are and to provide oversight. I have no doubt. But the reality is that their actions had results which show themselves in the fact, Mr. Selgin, that our economic recovery in combination with the decline of the deficit is the envy not just of Europe, but of every industrialized country. So if we'd gotten it wrong and we were at the bottom of that stack, I get this. The chairman, and I don't mean to pick on the chairman on this, holds up as his counterpoint to my contention on the stimulus that a bunch of witnesses, 4 or 5, selected, of course, by the chairman himself and the majority party, raised their hands to say they didn't like the stimulus. Reality matters. I would counter to the chairman that the Initiative of Global Markets, which is a survey conducted by the University of Chicago, hardly a hotbed of liberal thought, has surveyed economists across the political spectrum on the stimulus for a long time. Its most recent survey had 36 out of 37 economists saying that the stimulus actually improved the economy and reduced unemployment. Reality matters. And the reality is that we're criticizing the very people and eroding the monetary independence of the very people who were the one adult in the room with scare tactics. Ooh, some of this money is going to foreign banks. Well, guess what? Toronto Dominion, TD, they extend mortgages in my district in Southwest Connecticut. I know it's scary to say that we're sending money to foreign banks, but it's actually, as a politician, a little bit, for an economist, a little bit of a cheap political trick. The reality is that this policy has worked. Now, again, most of my constituents and most people here don't really understand what we're talking about. It's hard, this stuff. So let me offer an analogy. We had a major car crash. We talk about the crash a lot. Let's envision this as a car crash. What happened in 2008 was a car crash where 4 people are bleeding in the street. And Congress said, instead of 4 ambulances, we're sending you 2. So 2 people get taken off, this is the stimulus, and there's 2 people bleeding in the street. And the Federal Reserve says, geez, there's people bleeding in the street. We're going to send some helicopters, as they do from time to time. And yeah, that's extraordinary. We probably shouldn't do it for every car crash, but we didn't do what we needed to do. And so now you've got helicopters ferrying people to a hospital. Nobody says that's the right way to do it, but it was the only way to do it, and the patients all lived. And now we're saying, my God, the helicopters were expensive, and there's glass in the street, and it scared the neighbors. We shouldn't use helicopters. Folks, it was the only game in town.
Will the gentleman yield?
I'll yield when I'm finished. This was a tool that worked in literally a crash. And so I appreciate the equanimity that Dr. Taylor is showing in particular. I don't think anybody wants this to be a standard tool. But please, Mr. Chairman, and then I will yield, let's be very, very careful about scaling back authorities that had everything while we were negligent to do with the recovery and that we may need, heaven forbid, but we may need in the future. And yes, I will yield to the chairman.
Thank you. I appreciate that. And I'm assuming that if one is intellectually honest, one will also acknowledge that the drag on the recovery of the economy has oftentimes been linked to the ACA. It's oftentimes been linked to the regulatory environment that's been created, the tax policy that even our own president has said needs to be reformulated.
I'll reclaim my time and say, yes, those things have been linked to the recovery by my friends in the Republican Party. If you actually read, for example, the Federal Reserve, who we're talking about, they will tell you that this is a crisis of aggregate demand. They won't mention the Affordable Care Act. They won't mention taxation. They will mention it's an issue of aggregate demand. With that, I note that I'm out of time.
Gentleman's time has expired. With that, the chair recognizes the lady from Utah, Ms. Love, for 5 minutes.
Thank you, Mr. Chairman. Just a few questions, and then I'll yield back the remainder of my time if I have some time. Thank you for being here. As I have observed, the Fed has consistently and often badly overshot its mark in projecting economic growth, reflecting a misplaced belief that repeated rounds of quantitative easing, $4.5 trillion balance sheet, low record policy rates could reliably get our economy back on track. Earlier this year, for instance, Steve Forbes even mentioned that at the beginning of every year since 2008, Fed economists have predicted its actions would produce a robust expansion, and each year has had to sharply downgrade those expectations. I guess the first question is, do you agree with that assessment? Are you seeing the same thing, Dr. Taylor, when it comes to the Fed's predictions?
Yes, they've over-forecast the growth rate consistently through this period. I think to some extent thinking that their policy would be more effective. They will punt to other reasons, but that's a big factor.
Okay. So why, I guess the question here, the basic question for me is why, despite such sophisticated models, does the Fed consistently miss the mark? And why not use those models to fuel a robust economy or a robust recovery as opposed to putting the brakes on economic opportunity? Dr. Is it Selgin? Did I get that right?
Selgin.
Selgin.
Well, if they had good models, they could do what you say. The problem is that their models are not very good, and when they employ wrong models, they take wrong policy actions, like the December rate hike, which was at best counterproductive.
So you're thinking that the models are just
Yes,
not
and
very good
the
models?
fact is that the Fed can do damage when it employs bad models, and its experimentation often backfires. And this is why in Fed independence, to conduct monetary policy in the sense of being free to set the policy rate, which is the normal understanding of independence, to determine general monetary conditions, is not the same thing as Fed experimentation with activities and programs that it has never engaged in before. Independence isn't license.
Okay, so I guess this is my final question, because I think the important thing, the work that we do here, is to try and figure out how this relates to the everyday person. What does this mean for the family that's sitting at the kitchen table if we continue to have these types of practices and these models that are not working? What does that mean for the family? Did you have something you wanted to add, sir?
I'd like to respond briefly in the sense that you have to understand that the models that were being employed did not include experiments and experience like the Great Recession that we had. So the data that are underlying the models essentially mean that the current environment that we were in is out of sample forecasting, and the models didn't incorporate the kind of behavior and responses that the economy was in at this particular point in time.
So you're saying we were behind the ball?
Well, I mean, there's no way you can generate data that would have essentially allowed the Fed on a current basis to revise the models in a way to capture the current economic environment. So this is a characteristic of forecasting as a whole. We know that based on experiments that I did a long time ago, that showed that the Fed's models essentially are as good as anybody else's and better than most. But when you have an environment and an economic environment that is generating out of the normal behavior, you're going to have these kinds of errors. And there's really virtually no way to fix it.
Okay, I've got 25 seconds. Dr. Selgin, again, what does this mean? If we continue, what does this mean for the family that's sitting at home? How does this affect regular, hardworking Americans?
The biggest effect comes through the lack of private investment, productive investment, small business investment, as a result of the fact that the Fed, through its encouragement of banks to hold reserves, and they cannot both hold reserves and loan. They're either holding one kind of asset on their balance sheet or another in real terms. This has a drag on the economy. And I'd like to also add to that with respect to what Congressman Hines said. The Fed did not add an ambulance to the batch when it paid interest on reserves. It took one away. Interest on reserves in 2008 was a contractionary measure which took away from aggregate demand, and its avowed purpose was to keep banks from lending the new reserves that were being created at the time. So if you want aggregate demand to grow, and I think it desperately needed to grow at that time, if you want to have enough ambulances, you don't want a policy of interest on reserves implemented in the middle of a contraction. This is simply getting reality, which does indeed matter, wrong.
Thank you. My
Gentlelady's
time
time has expired.
Thank you.
With that, the chair recognizes a gentleman from Washington, Mr. Heck, for 5 minutes. Gentleman's recognized.
Thank you, Mr. Chairman. when it comes to this arcane subject of the Fed's authority to pay interest rates on reserves, I will admit in all candor that I am reminded of a couple of Mark Twain's phrases, one of which was, better to keep my mouth shut and allow people to think me ignorant than to open my mouth and remove all doubt. This just seems to me to be a question of how many angels can dance on the head of a pin. But I am heartened by the turn of this conversation, which has become, what is it that we can do to grow our economy at a faster rate than the relatively anemic growth that we have been experiencing? That fact notwithstanding, that I think we are now in our 74th straight month of private sector employment addition. Somebody used the other oft-used phrase earlier, this isn't rocket science. And when it comes to what it is that increases gross domestic product growth, I don't think it's rocket science either. You want to increase aggregate demand? Here's a real simple formula. This isn't hard. Increase employment and increase wages. Give America a raise and give more people jobs. And that's what we learned in undergraduate school logic class at tautology, A equals A. Why? Because our economy is nearly 70% demand driven by consumers. So you want to increase the rate of growth in this economy? Give more people jobs and increase wages. Voila, we will give it. Now, there has been some reference here, which seems off topic to me with all due respect, to regulatory environment and the like. Nobody's talked about the fact that the minimum wage has been stuck at $7.25 for I don't know how many years. I invite every single person sitting in this room, watching or listening, you want to live on $7.25 an hour? Try that out. See what it's like to be able to pay your rent and buy your food and provide for your children. $7.25 an hour. You want to move this economy faster? How about we stop under-investing in our nation's public infrastructure? In my district, fully 25% of the bridges are, from an engineering standpoint, deficient. You want to increase the economic growth in South Puget Sound and Washington State? Then complete State Road 167 into the Port of Tacoma, which will connect the largest warehouse district, the second largest warehouse district on the West Coast, to the largest container port in the Pacific Northwest. Fortunately, the state legislature passed a transportation improvement bill to do just that, bipartisan, but that will increase growth. You want to increase growth in South Puget Sound, increase aggregate demand, increase the growth rate of the GDP, then relieve the congestion on Interstate 5 around Joint Base Lewis-McChord, also included in this last transportation improvement package. Yesterday morning, I drove from Olympia, Washington to SeaTac, 52 miles, took me nearly 2 hours, no accidents on an interstate freeway. Ask yourself how much time people are sitting in traffic, moving at a glacial pace, not being home with their families for dinner or not getting their goods to market because we're under-investing in public infrastructure. Now, if there's one thing this entire Congress, Democrats and Republicans and liberals and conservatives ought to agree on, is 2% ain't cutting it. It is an aggregate demand economy. Let's sit around here and talk about how many angels can dance on the head of a pin, interest rates and excess reserves. But if we want to really move this economy forward, if we want to increase the GDP, then we need to increase wages and give more people's jobs. I wish to associate myself with the remarks of the gentleman from Connecticut. With that, I yield back the balance of my time.
Gentleman yields back. With that, the chair recognizes the gentleman from Minnesota, Mr. Emmer, for 5 minutes.
Thank you, Mr. Chair, and thanks to the panel for being here today. My understanding is we're talking about the tool, as it's been referred to, that the Federal Reserve was given as part of some legislation passed in 2008 to pay interest on reserves, and that supposedly was recommended many years earlier by Milton Friedman. But correct me if I'm wrong, I don't think Milton Friedman suggested pay not only on required reserves, because there's an implied tax, but I don't think Milton Friedman suggested paying interest on excess reserves. Am I incorrect about that?
I can't speak to what Friedman actually said on the specifics, but I'm sure that he would have argued that that it's the required reserves that really impose a cost on banks. But that's mostly because banks normally hold in this country very few excess reserves, and the only way you can get them to hold more than a few is by paying them interest on reserves, on excess reserves.
Thank you, Dr. Selgin, because let's say, if you go based on the facts, in 2007, the required reserves averaged $43 billion. Excess reserves at that time averaged only $1.9 billion. And with the exception of 2 months in our country's history, that had been the case for 50-some years. In fact, the case, as I understand it, is the excess reserves typically accounted for about 10% of the total required reserves up until this law was passed. And now we have this huge balance sheet with $4.5 trillion. And the panel has told us that you've got some ideas of how we're going to correct this. And before I leave it, though, Dr. Selgin, I think the important part is, the important point you made is not a partisan point. It's when you have all of this money sitting on reserve, apparently paying more money that maybe it could get out in the marketplace. You have the government distorting the marketplace, and that money isn't being put to work for better jobs and higher wages and new opportunities. Is that the point you were trying to make?
It is, and again, what's relevant is not the absolute amount of reserves, which would go up necessarily. It's the amount of excess reserves and how that has increased, and how it has increased in proportion to the overall size of banks' balance sheets. When we take the bank's balance sheets overall size as given, the question is, what are they doing with the resources available to them? If they are devoting them to holding reserves, then the investment is channeled to the Fed and channeled to the sectors the Fed supports. If they don't do that, then they are channeling the investment themselves directly to other uses, which, generally speaking, will be more productive. This is a mathematical certainty.
Dr. Taylor, quickly, and I'm sorry about the short time because I'd like to hear this from everybody, but of the different ideas that we've heard of how you reduce this excessive balance sheet, you start to rebalance it, if you would, divesting assets, allowing assets to mature and run off, these different ideas. Which one would be the best, and do we risk, if it's done improperly, inflation or deflation circumstances?
I think it requires all these things. In addition, I would say selling some of the securities in a way that is made clear to the markets. The Fed seems to be worried about doing that, but I think you want to go further than just let it run out to 2029. So that would be, I think that's the most important thing. And also I think having a goal that's where they want to go. There is this statement about normalization that they have, but it's not clear about where they're going eventually. I think that's very important so then people can plan. If I just add an example or an analogy, back when there was the controversy about the taper tantrum, that's because the then chairman of the Fed wasn't very clear about what they were doing with the balance sheet. As soon as they clarified, and this is with the new chair more, it was an easy thing to start to have the taper. It didn't cause disruption. I think it's very much the same now as if they were clear about how they would reduce the balance sheet. I've long ago argued that by the time the federal funds rate is at 2%, the balance sheet should be at the level where that rate is determined by the supply and demand reserves. I think that's kind of a goal that they could set. It's consistent with the tightening that they're planning on. Be well understood. I think it would work fine.
Thank you. I see my time has expired.
Gentleman's time has expired. With that, the chair recognizes the ranking member, Ms. Waters from California, for 5 minutes.
Thank you very much, Mr. Chairman. I am very pleased about this hearing today. This is just the beginning of a long-term debate that we are going to have on the Feds. Let me just say that when we had Federal Reserve Chair Janet Yellen here, she made it clear that allowing the Federal Reserve to pay interest on reserves, as long as there is an abundance of reserves in the banking system, is absolutely critical to its ability to gradually and predictably move rates up as warranted in the current environment. Now, I think it's important for me to say at this point that I have spent considerable time with Janet Yellen, wanting to make sure that I understood not only quantitative easing and what it had done, what it had not done, but I was very interested in this payment of interest on reserves and excess reserves, as it has been alluded to here. I have the greatest confidence in her, and I absolutely believe that she is making and has made some tremendously important decisions that have been extremely helpful. I think there's just a basic philosophical difference between this side of the aisle and that side of the aisle on whether or not the Fed should be independent. And I absolutely believe in the independence of the Fed, and I absolutely believe that what has taken place here, particularly with quantitative easing in that program that reduced long-term Treasury yields by more than a full percentage point, is important for us to know and understand. Lower, longer-term rates also supported stronger economic growth, helped the stock market recover, allowed underwater homeowners to regain equity in their homes, and had positive effects on consumer spending through the wealth effect. Lower long-term rates also made business investment more affordable and made the trade balance more favorable by lowering the value of the dollar. So I'm going to turn to you, Dr. Keister. In your assessment, would all of these benefits associated with the Fed's quantitative easing program have been achievable if the Fed knew it wouldn't have the ability to manage short-term rates through interest on excess reserves as part of the normalization process?
No, absolutely not. The ability to pay interest on reserves, including on excess reserves, I think was critical in allowing the Fed to know that when the time came to raise interest rates, it could raise interest rates regardless of the size of its balance sheet. And for that reason, it was able to undertake these large-scale asset purchases, which, as you mentioned, helped lower long-term interest rates and increase the flow of credit to consumers and households. If I may, I'd like to make one other point that I think has gotten a bit lost in this discussion. So Dr. Taylor had emphasized that allowing the Fed to pay interest on excess reserves going forward gives the Fed an additional policy tool, which is absolutely correct. And then he discussed some ways the Fed could potentially misuse that pool. But he also mentioned that the Fed's response to the early stages of the financial crisis in the fall of 2008 was proper. In response to a financial panic, the central bank should do what the Fed was chartered to do in the original Federal Reserve Act, that is provide an elastic currency, increase the supply of bank reserves, the supply of liquid assets when there's a flight to safety in the banking system. If the Fed were to lose the ability to pay interest on reserves, we'd be back in the situation we were in 2007. The Fed would face a conflict between being able to provide liquidity to the market in periods of financial turmoil and maintaining the interest rate that's appropriate with the stance of monetary policy. The Congress accelerated the authorization of the Fed to pay interest on reserves precisely to allow it to arrest the crisis in the fall of 2008. But had the Fed had that authority earlier, it would have been able to provide a much stronger market-based programs of liquidity assistance, which may, it's hard to know for sure, but that may have been effective in helping to prevent the worst of the financial crisis and thereby make some of the stronger programs that we saw later unnecessary.
Thank you very much. I noticed that the word experimentation has been used several times here, and I think I would object to calling the quantitative easing and the interest on excess reserves experimentation, it's flexibility, as I see it and understand it. And I know that Mr. Heisinger has proposed, or is proposing, that somehow we should absolutely bow down to the Taylor rule, and maybe if there's something extraordinary happening, like 2008, we could have flexibility. So I know you don't have time to answer that, but I think something that should be considered in our discussion as we continue to talk about the independence of the Fed. I yield back.
Gentlelady yields back. Time has expired. I'll point out that's not actually what the Form Act says, but that's for another conversation. So with that, the gentleman from Indiana is recognized for 5 minutes. Mr. Stutzman.
Well, thank you, Mr. Chairman, and it's good to see the panel. Dr. Taylor, good to see you. And you know, I enjoyed listening so far to the conversation. You know, one of the things that people back home often expect from Washington is that that it not stand in the way of progress, that it not stand in the way of growth. And you look at the history that we have here in this country, and the United States has been blessed with different periods of tremendous growth. But you look at what we've also seen in the past 10 years. Looking at an article right now that says that the U.S. has record 10th straight year without 3% GDP growth, and I think that this is only the way that things are going to feel better, be better across the country. When you talk to families in Indiana, in the 3rd District, they're wondering why things aren't better. What's standing in front of growth, and I think there's a variety of things to address that. And I think it's interesting too that while it may not just be Fed policy that affects growth, I think also you see the regulatory environment that we're dealing with out of Washington has slowed growth tremendously. Industries just don't know what to do. But I think that you know, when you look at the facts, and if you take a macro view of where this country's been over the last 100 years with the institution of the Fed, there's 2 periods in history. And I think this is what we all want. We all want to figure out what gives us growth, because that's the way the country is only going to move forward. That's the way families are going to do better. And there were 2 periods in Federal Reserve history when we experienced a tremendous amount of growth, and that happened to be in 1923 to 1928, and then in 1985 to 2003. In the first case, the Fed operated under some form of the gold standard, and in the second case, under the Taylor rule, more or less. And those were 2 periods where we saw tremendous growth. And I think that that's what's lost on Washington a lot of times, is the fact that that families are struggling today, that America could be doing a lot better, that we're not reaching our full capacity. To go 10 years without 3% GDP growth is really remarkable. And I think we all should be asking the question, why? Why is that the case? And I know we all want what's best for families, we want what's best for this country, for us to deal with the debt, for us to deal with increased wages. Something's going to have to give. And I think that this hearing is particularly interesting because it deals with the Fed, which I do believe affects our economy. And Dr. Taylor, I'd like to start with you about the balance sheet at the Fed. You know, why not just naturally wind it down? What's keeping the Fed from winding down its balance sheet? And I think that, you know, the more strength we see, the more opportunity and ability in the private market is going to give. I mean, I can feel it when I go home. People want to grow. But can you talk a little bit about the Fed and just why won't they naturally wind down their balance sheet?
Well, I think they could. I think they're reluctant to, for the same reasons they think the expansion was beneficial. And we heard a couple statements about that already. I don't think it was so beneficial. To me, they can undo this as long as it's gradual, certainly They can take some time to do it and be clear about it. I think that's the way to go. I think that there's, as you say, there's many other things in policy. And I do think this regulatory reform, I do think the fiscal reform, the tax reform, and all those things are very important. They go together to me. You mentioned these periods of time. Well, those are periods where you also saw good and bad other kinds of policies, too. So it all goes together, in my view.
Well, I don't know if anybody else would like to comment. Go ahead.
Yes, there's really two underpinnings for growth. One is for real economic growth. One is population growth, which contributes to economic growth, and the second is productivity. And productivity has really slacked off, and productivity growth has slacked off. And to me, that's an area where policy focus should be, as to what is holding back productivity growth at this point. Because on the one hand, we have technology and a lot of things in place that look very promising, but why isn't productivity growth expanding? The Fed can create a climate for growth, but it can't deal with productivity growth and some of the key underlying determinants of real GDP growth.
And absolutely, and I agree with that. But again, sound fiscal monetary policy is part, I mean, that's got to be one of the top priorities for us, especially in this committee. But you know, knowing energy, I mean, energy doesn't know what to do right now because of the policies out of Washington. Manufacturing, I mean, every time businesses turn around, they just feel another, you know, some sort of regulation piling on them, and that's what's slowing this down. But you know, for these purposes, the best thing we can do is to make sure that monetary policy is fiscally sound. And Dr. Selgin, if it's okay with the chairman.
Well, let's remember that you can achieve any level of monetary policy, any degree of contractionary or expansionary policy with any number of combinations of balance sheet adjustment and interest on reserves. Unwinding the Fed's balance sheet is contractionary, other things equal. But interest on reserves, or raising the rate of interest on excess reserves, is also contractionary. If right now we have a combination where banks are encouraged to hold high excess reserves and the balance sheet is very large. Now, even if you think that the overall stance of policy is sound, that combination implements the stance of policy in a way that involves less productive investment. The alternative is for the Fed to have a smaller balance sheet and for interest on reserves to be lower so that the demand for excess reserves is lower. You can have the same monetary policy stance but end up with much more productive activity as a result of more savings being allocated through the private sector banks and fewer through the Fed.
Absolutely, I agree with that, and I just think that, you know, we've got to focus on velocity in the economy, and this is one thing that's slowing down our monetary policies. With that, Mr. Chairman, I'll yield back.
Thank the gentleman. Now recognize the gentleman from Michigan, Mr. Kildee, for 5 minutes, give or take.
Thank you, Mr. Chairman, and I thank all the witnesses for your participation. My question is specifically for Dr. Keister. First of all, welcome and congratulations on a wonderful commencement exercise that you had at Rutgers. Got a lot of attention, and we certainly welcome Rutgers to the Big Ten. As a Michigan fan, I got to tell you, any chance we can have somebody come in to sort of slip below our ranking, we're happy to have you.
You're welcome.
Thank you. And I apologize if my question is redundant or has already been addressed. I was just able to get here to the hearing. But as I understand the hearing, it concerns the tools currently available to the Fed in order to influence short-term rates, in particular paying interest on excess reserves and overnight reverse repurchase operations. So, Doctor, in your testimony before our committee in February, in her testimony, Chair Yellen indicated that higher rates of interest paid on excess reserves would, in her words, eventually pass through to customers in the form of higher deposit rates. My first question, and I'll just pose both questions. My first question is, what evidence do we see that savers are actually benefiting from the increase in interest the Fed is paying on bank reserves in the form of higher deposit rates? And I ask this because I think it's important that we take a broader view regarding the resources that can be used to invest, particularly in distressed communities and cities, which has been the focus of a lot of my work. I have pushed that the Fed use all of its tools to meet the obligations regarding stable prices, but most importantly, I think, particularly in the areas I represent, to maximize employment. So how do you see the Fed's influence over short-term interest rates impacting its broader goals? If you could address those two questions, I would appreciate it.
Well, sure. So first, regarding the evidence that consumers are benefiting from higher rates, the whole goal when the Fed raises interest rates, it raises the interest rate currently that it's paying on excess reserves, and that drags up all market interest rates with it. I don't have specific data handy, but I do have anecdotal evidence. I pay attention to the interest rate I receive from my bank. And when the Fed raised the interest rate on excess reserves from 25 basis points to 50 basis points, the interest rate I receive went up. As I mentioned, I looked it up for preparing my testimony. It's currently 30 basis points, okay? So, and as the Fed continues to raise, as the economy continues to recover, the Fed finds it appropriate to continue to raise the interest rate it pays on excess reserves. Banks will compete for deposits, and as they do so, they'll bid up the interest rate that depositors are receiving. So raising the interest rate on excess reserves is designed to benefit savers, and that will happen. Could you repeat your second question?
The second question is, what are the implications for the Fed's broader goals, and particularly regarding increased employment? In other words, what are the externalities that you see in the broader economy resulting from this practice?
Sure. So the Fed is always, in normal times and now, trying to balance the competing goals of promoting full employment while keeping prices stable. Okay, and the decisions the committee makes on the interest rates are designed with those two goals in mind. So, as has been discussed here so far, one possibility of removing accommodation, and that is of restraining the economy as it continues to improve, would be for the Fed to shrink its balance sheet. I think the Fed has chosen, and Chair Yellen has testified, that doing so by shrinking the balance sheet is a less conventional way of communicating the stance of monetary policy to markets. A more conventional way is to do it by raising interest rates. And so the committee has chosen, at least for the time being, to normalize monetary policy by first raising interest rates and then later shrinking its interest rates back to, shrinking its balance sheet back to a more moderate size. In doing so, I think it's making a judgment that is reasonable in my view, that before taking the untested path of shrinking its balance sheet, it would like to make sure the economy is on a more sounder footing and to decrease the risks associated with any uncertainty or any market disruptions that could potentially be associated with that.
Thank you. I think my time is just about up. I yield back the balance of my time.
I think the gentleman now recognize Mr. Schweikert from Arizona for 5 minutes.
Thank you, Mr. Chairman, and you look good in that chair. Okay, I have a dozen, oops. I have a dozen different questions, and let's try to ram through them and see if we can sort of make them make sense. And forgive me for my mispronunciations. Is it Dr. Kester?
Keister.
Keister, okay. I remember a conversation about 2 years ago that the RRP sort of mechanics that we were looking at, particularly in light of deposit insurance, you know, sort of you arbitrage that a bit, that actually you would in some ways inflate up long-term mortgage rates, you know, because you'd be, is that what you were just telling me about your own personal experience on a home loan?
That's right. So if I understand correctly, you're asking, so as the Fed raised the interest rate on excess reserves, it also raised the interest rate on this new overnight RRP.
Well, yeah. I mean, it's obviously more than that. You know, you have the IOERs, you know, a pool, take away my deposit insurance, pull that out of the market. Would you then start to raise up my cost on mortgages? I mean,
that's right. So any time the Fed raises short-term interest rates, the goal is to be removing monetary accommodation, and that should raise longer-term rates.
Okay, Dr. Selgin, a couple of things I'm trying to get my head around. You know, first off, is this sort of system we have right now with the Feds dramatically sort of growing the way they're compensating excess reserves and sort of that reverse repo mechanic, has it started to squeeze out private providers of repo. I mean, because now I'm competing with, the Federal Reserve, and I no longer have deposit insurance. I mean, are we seeing that?
Yes. It's because of the way the Fed repo operations work. They actually don't, they take collateral from the marketplace. It's not available even though technically you have short-term purchases. That is, the Fed is borrowing, but it's borrowing in a way that doesn't take the collateral off its balance sheet and make it available to the private sector. So the result is that there's a shortage of collateral for other kinds of credit creation, including private repo operations, and this is a big problem.
Doctor, please.
Actually, what the Fed is doing is repoing its own securities out into the marketplace. So the securities actually become a liquid asset that can be repoed out or used as collateral for other activities. So it's supplying liquidity in the market in terms of the securities.
But even in that case, all you're doing is functionally, hey, I already hold the asset. That's my pledge on the repo. I mean, you're basically just pulling that
what it's doing is
cash out.
sterilizing part of the excess reserves.
Yeah, but that doesn't leave you any multiplier effect.
No,
in
it
the
doesn't.
Supply. And that was part of where I was going to go with this is, okay, fine, I get to use my existing book, I get to pledge it up, I get my repo, but if you're having an argument saying, okay, where's my liquidity, my expansive monetary policy, you're actually in some ways doing just the opposite, aren't you?
Well, it's designed to raise interest rates. It's a tool to sort of tighten policy in that sense.
If I may say, sorry.
Sorry. And tell me if I was wrong in my
no, you're not.
Attempt to explain.
We have to understand there are two ways interest rates can be raised. Dr. Keister referred to tightening money as a way of raising interest rates, which it certainly will do in the short run. But the overwhelming reason for low interest rates right now is the low level of GDP and overall nominal spending, and that has a contractionary effect, and interest on reserves contributes to that. If we buoy spending by creating more liquidity, instead of increasing the demand for liquidity, that too will eventually put upward pressure on interest rates, but in a way that doesn't involve overall tightening of credit.
This is one of those moments I desperately wish I had more time. Dr. Taylor, I need help on two things, and you got like 10 seconds to do it. If I come to you and say, the size of the book as it is today on the Federal Reserve, what does that do to lending velocity in the overall economy when my safe yield rate is, I basically have a free or safe rate with the yield, so my cash ends up going into the Federal Reserve instead of multiplying in the economy. And next, well, let's do that because we're out of time. So.
Well, I think in that case, these excess reserves are, if anything, signaling that they're going to be there for a while. So there's this notion they're going to be there for a while, and therefore we're not going to be back to normal for a while. And I think that's a problem with its effects on the economy. That's the main thing I'd say about that.
I couldn't find it, but somewhere I have an article about the allocation of capital argument, that one of the problems or lack of growth is we're not getting the allocation in.
I think in the federal, certainly
yes,
in the
it might
money
have a
markets.
little risk, but you get a multiplier. Is
Absolutely.
this the cause?
Certainly in the money markets, they haven't been functioning very well at all. Maybe they will as the rates come up a little bit, but that's an allocation of those funds to different banks and different parts of the economy, which has not been very effective with the near zero interest rate.
All right, Mr. Chairman, thank you for your patience. I yield back.
Now recognize the gentleman from New Mexico, Mr. Pierce.
Thank you, Mr. Chairman, and I would, if the gentleman from Arizona needs a little bit more time, I would be happy. I was going to follow right along in that line of questions if you, okay. So this idea that we're encouraging Dr. Keister, this is kind of at odds with your testimony, but it's something that I believe in real life, that we're giving incentive for banks to hold reserves rather than getting the money out to where it starts causing the economy to grow. You appear to approach it from a little different point of view. Can you explain why that that perception that you've been hearing just now, and is definitely rooted in my mind, is maybe incorrect?
Sure. So it's important to keep in mind that when the Federal Reserve creates reserves, as Dr. Eisenbeis mentioned earlier, they don't disappear. So the quantity of reserves in the banking system is going to be there, no matter how much lending goes on and other activity. Okay, so when the Federal, and also when, as I testified earlier, when the Federal Reserve creates reserves, that process also creates bank deposits. So banks are getting a new source of funding at the same time that they're getting a new asset. So that funding, that new asset is not crowding out other things, other assets they could be holding, loans to businesses or loans to consumers.
See, and I would perceive it exactly the opposite, that a bank is sitting here with its reserves, and they got a choice what to do with them. If they don't have that return on that investment, then they're sort of forced to do what banks are supposed to do. But I think now that a lot of banks are just sitting on reserves. I don't think they're out there, because I hear the small business people come in and saying, well, I got pretty good credit. I've never missed a payment, but I can't get a loan. I want to expand my business. And so the banks are being given an incentive to stay out of the business of loaning money. And so, again, I didn't quite, yes, sir, Dr. Sogan.
Well,
yeah, Sogan, yeah, go ahead. You seem to want to make comments. So
yes, I do. Thank you. It's true that when the Fed creates reserves, it creates an equal amount of deposits in the system, but it's also true that in the absence of interest on reserves, conventionally, and before the crisis, the total deposit creation, because of the lending of the extra reserves, that is, of the excess, would end up being something like 10 times the initial creation associated with the Fed's own expansion. So what happens in the interest on reserves, on excess reserves environment, what has happened is that that multiple of 10 has gone away. And this is why, as a ratio of their total balance sheets, the banks end up holding a much higher level of reserves than they normally do. It's the ratio that's determining the relative extent of productive investment that goes on, and that ratio of productive investment to reserves is what's down. Banks have control over that. If they didn't have control over the ratio, why in other cases where central banks have created vast amounts of reserves, you'd see excess reserves accumulating instead of banks lending more. Every hyperinflation we've ever seen would have been impossible because the banks would have just sat on their reserves.
Okay.
So it's not true that banks have no choice.
So if we're going to follow on and we want to add another variable into it, so now then you get regulators, you consider that, okay, maybe the interest has an effect, maybe it doesn't. But when you get regulators coming in and looking at the bank and saying about fairly safe loans, that we're going to classify this loan. So now then you have just the suggestion says I'm better off being on the sidelines because of the regulatory impact of very good loans. And again, these are loans that I've heard about in our district where people say, why would I ever lend money when the regulators are going to say this and they'll pay me not to lend money? And so it is in a state like New Mexico with a small economy, we got 70 days worth of funds to lend for houses. So, I mean, it's not like the state is swimming in cash reserves, and yet we're giving these depressing effects. So we have not seen that dramatic economic growth that is being proclaimed here in Washington that's occurring. Dr. Taylor, do you have an observation? I see you.
Yes, I think during this period where they had a 25 basis points interest on reserve, it's really in retrospect, I think Dr. Selgin is correct about this. In retrospect, let's see, why they do that. I think Dr. Keister is saying, well, they were doing that because they wanted to be ready to move it from 50 basis from 25, which is not clear why they had to do that. So I think a lot of these questions wouldn't be there had they just not paid interest rates on reserves. They had the right to do that, obviously. It doesn't mean they have to pay interest. They could have paid zero starting back in 2008 until December of 2015. I think in retrospect, certainly would have been a better thing to do. They've given lots of answers to that to people over the time, I'm sure. I think the main one is to be ready. The mechanism is there, and I think it's questionable.
Yeah, and then just then a last point, and thanks, Mr. Chairman, for a little bit of the time here. But the banks a little bit get out of the perfection of making good loans versus bad loans, and so they're uncertain because their activity has shrunk down due to regulatory things, and cash reserves are being really encouraged. And so I find that the banks even get a little out of practice in determining what's a good loan and a bad loan, and then they're even more hesitant at a time when we need them to be more courageous. They're more hesitant and the economy suffers. Thank you, Mr. Chairman, for your indulgence.
I thank the gentleman, and while we're not going to do a second round, Ms. Moore was very gracious in allowing me to maybe ask just a few more questions to finish up on some our dialogue earlier, Dr. Selgin. To refresh your recollection, we're talking about the Fed not marking to market, the balance sheet implications of the value of their assets and so forth. And then you made a comment as the time was expiring about the P&L, the profit and loss impacts of that, and whether or not if their earnings, the net earnings turned negative, they might have to come hat in hand to Congress. I had actually asked Dr. Bernanke that a question along those lines 2 years ago, where in a rising interest rate environment, you can foresee a situation where the net earnings of the Fed go negative. That they'll have to end up paying off much higher rates of interest. They won't be earning as much on their balance sheet, et cetera. And I asked him what would happen, and he did not say that they would have to come hat in hand to Congress to ask for money. He said they would simply take it off the balance sheet or adjust the balance sheet. I never really understood exactly what he was talking about. I got the impression what he meant was they were going to conjure the money up the same way they do to buy it. Dr. Eisenbeis is saying no. Dr. Selgin is looking at me like he's not sure what I'm talking about. I'm just curious to know what might happen in a situation where the profit and loss turns negative for the Federal Reserve. We'll start with Dr.
I have the
Eisenbeis
answer
and then
to
go to
that.
Dr. Selgin.
I have the answer to that, sir. According to the way the law is set up, when the Fed income is no longer sufficient to pay interest on reserves, they stop making remittances and write the difference up in this negative asset account that I was talking about before. And what that is that that's a claim on future revenues on Treasury securities and assets on the balance sheet that as it's received would be used to write down that account, and when
They
it's
can
zero,
borrow
then they
from
would
their
start-
own future earnings is what
Yes.
it's something that a private business can't do, right?
No, actually, there's a loss carry forward, but it's not really totally analogous to this.
I've never been able to monetize a loss carry forward. I have news for you. It's hard to do, but go.
The Fed can do it, however, but it's really a sort of an accounting gimmick to sort of preserve and enable the Fed not to have to go to the Treasury.
Well, it's not that common because it's never happened, right? The Fed's never.
No.
Okay. Dr. Selgin, are you in general accord with that?
For it to pull this trick.
It does have to be covered somehow, but my understanding is that they can monetize these future earnings to this negative asset account, and essentially they have to have cash because the cash has to go out the door. And it's self-monetization. They essentially conjure the money up, correct? Dr. Keister.
I'd just like to add one point. So this possibility we're discussing is the flip side of the large remittances the Fed has been making to the Treasury over the past few years. The entire problem could be avoided if the Congress authorized the Fed to create a reserve fund to hold back some of these large remittances until it's able to shrink back its balance sheet and this possibility has disappeared.
That is a fascinating idea and sounds like a great way to solve the GSE problem. Dr. Eisenbeis, did you have one last thought on that?
Yes. In fact, the opposite has happened because the Fed surplus in the highway transportation bill, $20 billion of it was taken off the Fed's balance sheet, so now they have only $30 billion in equity, combination of paid-in surplus and everything. So
I think that was noted on one of Ms. Moore's earlier graphs as an additional remittance during last year. So if there's no further follow-ups on that specific topic,
That was great.
do you have anything else?
No, it's a good question.
I appreciate the ability to ask that question.
Mr. Chairman, may I make just one other clarification? And it has
I'll
to
stay as long as Ms. Moore wants to. So.
relates to why the effective federal funds rate was below the target. And the reason was because Freddie and Fannie were not able to hold and earn interest on their deposits at the Fed. So they were accumulating large amounts of excess funds and lending them out into the federal funds market, willing to take a rate below the target rate because they had no other alternative. And that's the reason the effective funds rate was below the target.
Fascinating. I will remind all the members a couple different things, and one we don't talk about very often is that we do have the opportunity to ask you questions in writing for the record afterwards, and I encourage all the members to do that. We also, without objection, have 5 legislative days to, to submit additional written questions. Thank you. Which we forward to the witnesses for their response, and we'll have 5 legislative days within to submit extraneous materials. Do you have anything else?
Just thank all the witnesses for your indulgence, and we learned a lot.
Thank you. The hearing's adjourned.